You might have seen the headlines about MillerKnoll's latest earnings report, and yeah, they didn't look good. But here's the thing, the full story is way more complicated and honestly a lot more interesting than what you've heard. So let's get into it.
Okay, so this is the number that just screamed from the headlines. On March 25th, right after they dropped their Q3 earnings, MillerKnoll's stock just plummeted. We're talking a massive hit, down over 22% in a single day. I mean, that is an absolutely brutal reaction from the market.
So when you see a drop like that, your first thought is, wow, something must be seriously wrong with this company, right? But is there? That's what we're here to figure out. We're going to look right past that big, scary number, dig into the actual report, and see what's really going on. All right, to understand why the stock took such a nosedive, we got to start where pretty much every investor starts. We need to look at the big headline numbers, how they did compared to what Wall Street was expecting.
And, well, here's the problem. The company reported earnings of 43 cents per share. Now, Wall Street was banking on 45 cents, so that's a miss. And on top of that, their revenue also came in lower than expected. For investors, missing on both of those key metrics, that is a huge red flag. It's the kind of thing that makes people hit the sell button almost instantly.
Okay, but this is where things get interesting. This is where our deep dive really starts. Because if you only look at those headlines, you're missing a completely different story, a much more positive one, that's kind of hiding right there in the details of the report.
You see, revenue and earnings, they tell you what just happened. They're like looking in the rearview mirror. But there's another number in this report, a key metric, that gives us a much better idea of where the company is headed.
Just look at this. This is the difference between sales and orders. Now, their net sales, they were up a very respectable 5.8%. That's good. But check this out. New orders, we're talking about new business that customers have already committed to, were up an incredible 9.2%. That gap between sales and orders, that is absolutely crucial. It's a huge signal that demand for their products is actually speeding up, which points to some serious growth down the road.
So where's all this business coming from? Well, let's break it down. Over half their money, 54%, comes from what they call North America contract. Just think big office projects, that kind of thing. But what I want you to pay attention to is that 28% slice from global retail. Keep that in your back pocket, because as we're about to see, it's a huge part of their game plan. And the rest, that comes from their international contract work. And the good news just keeps coming. It's not just about the orders. The company is also just really well run, financially speaking. I mean, they pulled in $61 million in cash from their operations, they paid down $41 million in debt, and they improved their gross margin. On top of all that, they kept their dividend going, which is a big signal of confidence to their shareholders. You put all that together, that's the scorecard of a very healthy company. Okay, so if the business is this strong underneath, what gives? Why did they miss earnings? And why the kind of gloomy forecast? Well, it turns out MillerKnoll, like a lot of big global companies right now, is trying to steer its ship through some pretty choppy waters. In their report, they pointed to three big things. First, the ongoing conflict in the Middle East is causing some very real problems for them. Second, you had some really severe weather events right here in North America that messed with everything from people going to their stores to their actual factory operations. And third, of course, is just this general economic uncertainty that's out there, making everyone, both businesses and regular shoppers, a little more careful with their money.
And look, these aren't just some vague excuses. The company put a real number on it. They're expecting that around $12 million worth of orders, products that are ready to ship out, just can't be shipped next quarter. And that's specifically because of the disruptions from the conflict in the Middle East.
And then their CFO, Kevin Volkman, he came right out and put an even sharper point on it. He said, hey, we're expecting a direct hit to our bottom line of between $8 and $9 million. And that is a huge reason why the market freaked out. It takes this distant geopolitical thing and makes it a real, tangible cost that you can see right on their balance sheet.
But here's the thing. MillerKnoll isn't just sitting there, hoping the world calms down. Nope. They have a very clear game plan to push for growth, and it's all about leaning hard into one specific part of their business.
So here's the strategy. They know that big contract business is facing all this global uncertainty. So what do? They're going all in on their global retail business, pushing aggressively into that direct-to-consumer market. They see a huge opportunity right now in high-end home furnishings.
And it's not just a vague idea, they have a detailed plan. It's kind of like a four-pronged attack. Number one, they're opening new physical stores to expand their footprint. Number two, they're expanding their product lineup. Number three, they're accelerating their e-commerce game. And number four,
They're cranking up the marketing to boost brand awareness for names you probably know, like Design Within Reach and Herman Miller.
And again, they're not just talking a big game, they're actually doing it. Get this, they're planning to open 14 to 15 new retail stores in this fiscal year alone. That's more than one new store every single month. That tells you they are putting serious money where their mouth is.
And this isn't just some quick fix either. This is the start of a long-term, multi-year strategy to basically double their entire store footprint for brands like DWR and Herman Miller. I mean, they are fundamentally reshaping their company to be a much, much bigger player in the direct-to-consumer space.
So when you pull it all together and step back, it's pretty clear. This last quarter for MillerKnoll wasn't a simple story. It wasn't just good or bad. It was kind of both. It's really a tale of two stories. On one side, you have the bear case, right? The negative view. They missed their numbers, and they're dealing with real, measurable risks from global conflicts and bad weather. That's what spooked the market. But then on the other side, you've got the bull case. Order growth is actually accelerating, the company's financials are rock solid, and they have this clear, aggressive strategy to grow their retail business.
So what does that all mean? Well, what we really have here is a fundamentally healthy, well-managed company that's just trying to navigate a pretty chaotic world, and all that chaos is hitting their short-term results.
Which really leaves us with a million-dollar question, doesn't it? MillerKnoll is making a huge bet. They're betting that their own strategy, especially their big push into retail, can generate more growth than all these global headwinds can slow them down. And whether or not that bet pays off, well, that's the story we'll be watching for in their next earnings report.